We are live now, doctor.
All right. So, hello everyone. Good evening. Thank you all for joining this evening for this wonderful webinar series. It's going to be a series related to personal finance management. And we have two wonderful people from CAGRfunds, which is a wealth management and equity advisory company. And we have Mr. Vikas Agarwal, who is also director and primary advisor at the CAGRfunds. And we have Mrs. Shruti Agarwal also, who is also director and primary advisor at the CAGRfunds. So I'll be introducing Mr. Vikas first. Mr. Vikas is a chartered accountant by profession, and he's also a chartered financial analyst by profession. He has over 13 years of experience in financial services ranging across all the investment products, treasury and foreign exchange, and etc. He started his career with the Federal Bank Mumbai Treasury Department after his CA. And then his passion was towards investment and personal finance, about reading about, after having a knowledge about all the great investors like Mr. Warren Buffett and Charlie Munger and Mr. Parag Parikh and all those, all of us know. He's based out at Mumbai. And Mrs. Shruti Agarwal is also, she has done her MBA from MDI Gurgaon, and she is chartered financial analyst by profession. She is also having more than 13 years of experience in strategy and financial services, ranging across investment banking, business strategy, and wealth management. She started her career with JP Morgan, later worked at M&M on on-ground execution and new business. Mrs. Shruti has a passion about personal finance, as she discovered that her passion for behavioral coaching around the investing biases. So today we are going to have a session for all the young ophthalmologists who are starting their journey as a resident doctor or early phase of their career and joining the institute or having their first job and started earning money. So because a whole life of an ophthalmologist, they all push us about learning surgeries, doing topical phaco's for a cataract surgeon, retina surgeries for retina people, and etc. But nobody teaches us about the finance and financial management. Even if once we start earning, many of us who have seen money for the first time, they don't know how to manage it, how to invest it, how to grow it. And that is the whole purpose of this financial awareness series, to help all young doctors like me and like all of you to start their journey, or if you are already in the journey, it can help you to grow at different levels. So today we are going to talk about mastering saving, investing, and compounding, and Dr. Shruti will help us to unlock the power of money. So I'll be inviting Dr. Shruti Agarwal to give her talk today.
Oh, so thank you so much, Dr. Nikunj. I think it's very self-explanatory. You've been addressing me as Dr. Shruti, so it it shows how deeply we are engrossed in what we do as a source of competency. But that besides, thank you so much for having myself and Vikas on this platform. It's absolutely a pleasure interacting with young doctors. We have been into wealth management for almost 10 years, and one of our observations, and correct us if we are wrong, is that doctors are it's a very subject matter expertise domain, and whenever we meet people who come from subject matter expertise domain, we often see that other aspects of life tend to get ignored. For a lot of people, taking care of their health gets ignored, but similarly for doctors specifically, we see that personal finance appears to be a subject which is outside their competency, and therefore not something that is prioritized. So, getting an opportunity to speak to young doctors here is actually, we would consider ourselves lucky to be able to do that. And we are actually very excited to be a part of YOSICon, and we look forward to interacting personally with the doctors in Delhi in September as well. So what I'll do is I'll quickly share my screen, and we would love this session to be interactive. So any doctor, over here who has questions in between the sessions, please feel free to drop your questions on the chat box, or even if you want to unmute yourself and ask a question, please feel free to do that. The more we discuss the topic that we are doing right now, the better it will be as we go forward with the remaining part of the series. So I'll take you through a little bit of my journey, specifically with certain things. So growing up, if I try and remember about some of the things that my parents bought, or some of the expenses that I saw around myself. So my parents bought a. I'm from Calcutta, by the way. So my parents bought a property there for their own living. They bought a house there in 1990. And a couple of years back, I had asked my father, like, how much did you pay for it? And he said that we paid 8 lakhs for it. Um, their first car, which was Maruti 800, which was the car for a lot of other people and a lot of other families in India as well, in 1996, costed them 1.8 lakhs. um, like when I was going to school, it was very hard to find the cost actually. Nobody really spoke about schooling costs back then. But, I did some research, I found out some of the receipts, and I realized that the cost of going to school in 93 was 800 per month, rupees 800 per month. And this bread, the loaf of bread, in 2009, and 2009 is not too far back, it's 16 17 years back, it costed rupees 14. But cut to today, and the kind of you know expenses that I see now. So my parents spent around 2 lakhs for a car, but today if you see anybody who's looking to buy a car, nothing comes below 20 to 30 lakhs, right? And if you see that on an average annual basis, how much has the cost increased? Like if they were spending 2 lakhs in 96 and we are spending 30 lakhs today, this is equivalent to 10% increase in the cost of purchase every year. Similarly, a house worth 8 lakh today, um, in a city like Delhi and Bombay, it's specifically Gurgaon and Bombay, tier one, a simple 3 BHK does not come below 5 crores. It could be that these numbers look different across places, but I'm talking about tier one cities. This translates to a 13% annual increase in cost. Similarly, even something like bread, which is a part of our daily consumption, that has also grown at 10% per year. And schools, we shouldn't even discuss this. The kind of cost increase has been humongous. Um, my daughter goes to a CBSE school in Bombay, while my parents paid 800 rupees per month for my schooling back in 93. I am paying 50,000 per month for my daughter's schooling in a very reasonable CBSE school in Bombay, right? Now, when I thought about, why these costs have risen, I also realized that these rise in costs is not just simple increase in the cost of living. The point is that, when the cars were introduced back in the early 90s, everyone was happy about getting a Maruti 800 because that was the premium possession at that point in time. But over a period of time, you would have seen that people have migrated from small cars to hatchbacks. And now anybody buying a car is probably buying a compact SUV or an SUV. So the whole cost structure and the preference structure has changed. Similarly, when you come to housing, you've seen that earlier people used to have flats and standalone buildings, or they used to have houses which they used to construct on a piece of land. As opposed to that, a lot of migration is now happening to very good quality societies with very good quality amenities, and which is what is increasing the cost of purchase today. Bread, again, we used to buy white bread. There was no other form of bread at that point in time. But now, there are so many other forms of bread. There's white bread, brown bread, multigrain bread, and so many other forms of breads available that even if you migrate to a higher form of bread in the name of health, the cost significantly increases. And similarly, schooling, the kind of infrastructure that we now look for, the kind of amenities that we now look for, the kind of exposure that we now look for our children is very, very different, right? So when I was looking at this and I was, visualizing that, okay, what if I were my parents, and if I had to visualize 20 years forward, and I have to think about how will things look when my daughter is 18 years old or 15 years old, she is 5 today. So I realized that, what my parents did is they actually, I mean, a lot of their financial capital was kept in FDs because that is what people used to do then. Now, of course, back then the returns were slightly better. I remember my when my parents were doing FDs in 90s, the returns were close to 10, 11%, even 12% at that point in time. But if I have to do the same thing today, if I have to think about schooling cost of property, lifestyle, etc. today, and if I do an FD today, it would be giving me a 7% return and 7% is a good FD return. But then if I pay 30% tax on that, the net return that I'm actually getting is 4.9%. So what is really happening? The money that I'm earning today, I'm going to save it to fulfill goals that will come in the future, whether it is education, it is a house, it is setting up your own business, it is about your child's education, so on and so forth. If I'm earning close to 4 to 6% of my money's worth, but the cost is going to rise at a 10% kind of a number, I'm definitely going to fall short of what I need in the future. And one of my favorite quotes is from Robert Allen, who says, "How many millionaires do you know who have become wealthy by investing in savings accounts?" I know none, but a lot of people who have actually made money in the last 20 years, it's always been through growth assets. It could be a cycle of real estate when real estate was doing very well. So somebody who bought a piece of land, they did very well. Somebody had like a very high exposure to maybe financial equipments, they did very well. Somebody who invested in a business and the business did very well. That's where the wealth actually came from. The wealth was never made from bank accounts and FGs. That's where we have just protected our capital. So my point is that why are these costs looking so different? So, like I said, it's not just about, we hear a lot of these terms like inflation, right? You would have also intermittently heard of a term called inflation. So what is inflation? Inflation is basically every year, what are your costs rising? What's the rise in your costs? So let's say you stay in a tier two city. Let's say I saw somebody from Gujarat over here. So let's say you stay in Ahmedabad. So the cost of living in Ahmedabad would be rising every year. Similarly, the cost of living in Chennai would be rising everywhere. So that's inflation. That's a basic minimum cost that increases every year. But then there's something called lifestyle inflation, which we normally don't, kind of visualize. So the lifestyle inflation, which we don't visualize, is what is, we need to really think about. Now, what is this lifestyle inflation? It is basically, as we start earning more, we tend to upgrade our lifestyle. And by upgrading a lifestyle, I mean that you would want to go to bigger houses, you would want better schools for your children, you would want better vacations, you would want to have better exposure, more experiences, better, in the field of medicine, maybe better equipments, better technology, and all of this comes at a cost premium, which is why you would see these kind of changes that I am seeing in these numbers. So when I have this conversation with my mother and she says, "Yaar, hamare to kharche hi nahi hote the us time. We never thought about planning for school expenses." But frankly speaking, the clients that I'm dealing with today, they are very much thinking about school expenses because think of how things have changed. When I was growing up, my mother was a homemaker. We did not have the concept of nannies so prevalent at that point in time. We did not have daycares at that point in time. Come to today when both partners are working, you cannot think of a situation where you don't have adequate staff to support you to continue your lifestyle. So a lot of variables of cost have changed today, which was non-existent maybe 30 years back, which is why these numbers look so starkly different, right? And this is where we need to understand what is the difference between savings and investing. The reason we chose this topic for the first session is because, when I speak to a lot of people and I ask them, कि यार आप कितना बचा लेते हो? तो they say हम इतना सेव कर लेते हैं. And I ask, आप कितना उसमें से इन्वेस्ट करते हो? तो कहते हैं यार इतना सेव कर लेते हैं. I mean, it's very difficult for people to understand what is investing. How is investing from different from saving? So where does the money flow come from? One is how much you are earning. So आपकी salary क्या है या आपका business income कितना है? And after that, it is about आप खर्चे कितने करते हो? What are your expenses? Post your expenses is what you save, right? But out of that savings, are you really investing in assets which can grow at a rate which is higher than the rate at which your cost will grow? That is investing, right? So if we have to just enumerate the difference between savings and investing, basically savings, the type of products that you would see in savings would be FD, saving account, PPF, and anything that is giving you a guaranteed rate of return, but is also giving you a lot of safety of capital, right? So the objective of using a savings instrument is to protect capital, right? You're not taking any risk. There is no volatility. The value is not going up and down, but you would see that the returns are always in a range of 6 to 7%, 7.5%. Anything which is giving you a return higher than that, it is not coming without risk. Even if your bank RM comes and tells you, madam आप इस product में invest करो ये आपको 10% return देगा, there is no risk. It's false. There is risk. There is nothing that comes at a return which is higher than your, maybe FD rate is a good proxy. Anything which is giving you higher than your FD rate cannot come without any risk. The point is, do we understand what risk we are taking and how much risk should we take to grow our capital? So saving is usually a low return capital protection instrument, very suitable for short-term goals. So let's say you have to buy a car next year. Then you would accumulate that money in your savings account. You would ideally do it in an FD. Or you want to put your emergency capital. You want to have a contingency fund. You would put it in an FD account or a savings account. You have a vacation that's coming up in 6 months. You will put it in your bank account. But if you're trying to plan for a house that you are looking to build in 10 years, or you are trying to plan for sending your child abroad for education, or even for education in India, which is 15 years away or 10 years away, savings is not the instrument which is going to grow your money to an extent that you will be able to meet the cost 10, 15 years down the line. And I will give you a little more example of this in a very real fashion when we do a little case study kind of an approach in the later part of the series over the next few weeks. But you'll understand how it's very important to segregate your surplus money after your expenses between savings and investing, right? Saving is important to have liquidity. पैसा होना चाहिए अगर चाहिए. So that is what savings is important. But investing is extremely important to beat inflation, to beat your lifestyle cost, and take care of your long-term goals. And the reason as I say this, we have a client who's a very young doctor, became our client a couple of years back, and when I was making this presentation for this audience, I thought it would be good to share his case with you because a lot of you might be able to relate with him. So Varun is a doctor. When he came to us, he was single, but he subsequently got married. 33 years now, living in Bangalore. Wife is working as an HR in a company. So he started working as a resident doctor when he was 28, and he came to us when he was close to 33, right? So after 5 years of working actively, and he told us that after all my expenses, he was living on rent in Bangalore, and he said that after all my expenses, I'm able to save approximately 50,000 a month. And he said that so far, because it's not been a very long time since I've been working. There have been certain purchases that I made, some spending that I have done on recent vacations. I recently got married. So there's 4 lakhs in a Yes Bank account. So I asked, why did you do Yes Bank? He said, yeah, interest zyada milta hai. So they are giving me a better savings rate of return. So I actually opened a new Yes Bank account and put my money there so that it can give me slightly extra return. What is that extra return? It was at that point in time, it was giving him, I think 5.5 or 6% kind of a return. I think 6% return, as opposed to an HDFC or an ICICI bank, which was giving him 3.5. So he said that extra return was useful, so I did that. So before that, he was just parking his savings in the bank account. He was really not tracking where was he spending, how much surplus was he having every month. Um, he recently got married, so he liquidated some of his FDs to fund his vacations. And the reason he came to us is because one of his colleagues started investing in mutual funds, and he felt that his awareness was very, very low. And somebody in his family referred us to him, so he came to us, right? So this is his actual numbers, right? So he had 50,000 surplus every month. For 5 years of when he was doing it himself and he was investing it in, not investing, saving it in his bank, he basically could have accumulated 30 lakhs in those 5 years, right? Um, if I take inflation into account, which is close to 6-7%, and if I think about 30 lakhs today, in 5 years' time, to buy that same thing, I would need 35 to 36 lakhs if I take inflation into account, which means that something which is costing me 30 lakhs today will cost me 5 to 6 lakhs more just 5 years ahead. We never think about this, like this, that, if I'm buying a car for 20 lakhs today, it actually might cost me 24 in 5 years, right? And how do I ensure that 20 lakhs today grows to 24 in 5 years? So if he would have invested 50,000 per month in a bank recurring deposit or in savings instrument, after paying 30% tax, the net value of his corpus would be 33.9, 34 lakhs. Let's assume 34 lakhs, which would be lower than the value that he would have required to make the purchase in 5 years, right? So when we compare 30 to 34, we feel, ha, yaar, grow kiya hai. I've gotten some return. But the point is, you are not getting a return. You are actually losing money because आपके खर्चे ही बढ़ गए. The cost has increased by 6 lakh, whereas your saving has only increased by 4 lakhs. So you have actually lost 2 lakhs, right? And when we told him this, and he said that, okay, you tell me what else could I have done? And we just, did this number analysis for him, and we told him that, just to give you some awareness, even if you would have invested in an index which has 50 largest companies. And the reason I'm talking about mutual funds here is because we come from that industry and we are a little more hands-on with that. We understand that asset class better, which is why a lot of our examples will be around mutual funds and equity. So we said that, this number in 5 years could have looked like 40, 41 lakhs. So at least that cost of increase of 5, 6 lakhs, you would have actually grown your money beyond this. And now let's, project this situation to 15 years. He did not have to buy anything in 5 years, honestly. But when we do this over a 15-year period, the investment, the amount of money you would be investing would be 90. This cost in 15 years would have become 1.5 crores. So today, just to explain this, if today if today something is costing you 90 lakhs, let's say some education, degree is costing you 90 lakhs. In around 15 years, that would be close to 1.6 year. So if your child is 5 years old today and you are planning to send him abroad and you feel that आज 90 lakhs लगता है, 90 को आज मैं FD में डाल दूंगा, this will work, it won't work, because the education cost would have risen at a much higher pace and you would probably need higher than 1.5, 1.6 year to fund the entire education. And because we are not able to think like this is the reason a lot of us have to go for education loans or external assistance to fund some of these wishes that we have. But the interesting part is not just that. The interesting part is this, this part. That had he invested this in a bank FD, over a 15-year period, the 90 lakh on after paying tax would have grown to 1.3 crores, right? After paying tax. So yes, that looks like a good number, right? If you buy a piece of land in 15 years, if you buy a piece of land for 90 lakhs, in 15 years, you sell it for 1.3, 1.4 CR, everybody would tell me that, yeah, return. I have made a good, decent amount of return, right? But the point is, you've actually lost a couple of lakhs here. You have not beaten inflation. Your cost of lifestyle has increased at a much higher rate. But the same thing in that same Nifty index that I was showing to Varun would have resulted in a corpus of 2.5 CR. Right? So an FD of 1.3 CR versus a simple Nifty 50 index. Nifty 50 is like the 50 largest companies of India. So I'm not even talking about risk right now. Right? But that 1.3 CR would be 2.5 CR. That's almost double. Right? And why is this happening? So before I explain why is this happening, we would like to play a small video, and let me know if you can hear the sound. Yeah, we'll just play a small video.
The sound is not there, I guess.
The sound is not there. So I'll just share the YouTube. Can I share YouTube link? Can I share my screen on YouTube and show this? 1 second. Just 1 second. I'll just share my screen. Let me know if it's audible now.
Can you play it and just...
It's not showing, right?
No, it's
No,
not
the
audible.
audio,
But while you're
it's...
sharing the screen, there is a pop-up option which comes on the right side of the screen, share sound. I think once you
Okay,
click
just one
upon it,
second.
maybe it will come.
Okay, I'll just try. Just give me a second. I'm so sorry for this.
No.
Okay, so Dr. Dipanshu, can I share this link with you? Can you just circulate it in the
Yeah,
circle later on? I think that would work as well,
that will
instead
also
of
work. But can you
spending
just give us
time.
a gist of the video, if what is it about or
I will,
something?
I will. So basically, this is a very interesting story, about a certain fellow in a village, who is in a very poor situation, and he feels that what can I do to earn some money? They don't have even food to eat. So he thinks कि यार ठीक है मैं राजा के पास जाता हूँ, and he I think he sang some song for the king, and the king was very impressed, and he said कि ठीक है आप इनाम मांगो, आपको क्या चाहिए? So he said that, why don't you bring a chessboard in front of me? So a chessboard has 64 squares. And he said that what I want from you is that on the very first board, you just put 1 grain of rice, right? And then you keep doubling the number of grains of rice on every subsequent box. Okay. So the king said, this is very easy. You're asking nothing. So he said that fine. He called his ministers. They started putting their grains of rice. So on the first box, they put 1 grain. On the second box, it was 2 grains. On the third box, it was 4 grains. On the fourth box, it was 8 grains. On the fifth box, it was 16, then 32, then 64, then 128. And by the time, they reached the 64th box, actually the whole village ran out of the grains of rice. The village did not have enough rice to fill 64 boxes. In a pure mathematical sense, it's a very simple way to calculate. So basically, what he was doing is compounding, and this is a very real life manifestation of compounding. He was doubling the number on every subsequent box. And when you double the number, it is, you know, intuitively it feels like, yaar, kya hi number hoga? 2 plus 2 plus, what can it get to? But the point is not, it does not work like a 2 plus 2 plus 2 kind of a number. It works 2 to the power of 2 to the power of 2 to the power of 2. And when you put a power of 2, it exponentially rises to a very large number. And, in the context of in the context of investing, this is very, very important. One second, I'll just change the screen. So in the context of investing, it's very important because, uh, it over very long periods of time. So why we show this video to you is, if you actually create an analogy between your time period of investing. So if you are, let's say, 30 years old today, and you will be working for another 30, 40 years. So you are equivalent to those 30, 40 boxes on that chessboard, right? And if you are able to, double your capital over a certain period of time, the kind of corpus that you can actually create for yourself can be significantly different from what a low return instrument can do. This is also very important because, normally kya hota hai? We try and understand, yaar, where do I invest to get the best returns, right? So we'll ask, yaar, bata do is saal kaun se instrument mein kare? Where can gold mein laga de, silver mein laga de? What should I do to get the best returns? The point is not about getting the best returns today. The point is about getting a good return over a very long period of time. Now, as humans, the problem is we are not able to visualize that long period of time. And which is why you would see, even for Varun, when we look at a 5-year kind of a number, it is not looking very lucrative. ठीक है यार, 35 होगा, 34 होता, 40 हो गया. But over a 15-year period, it becomes very different. Over a 25-year period, this difference magnifies further. And if you think about, like for my parents, they would have saved for 40 years. All of us, specifically, for doctors who typically do not retire, you earn for a much longer period, right? And if you are able to think about investing for such long periods of time, it's very feasible for you to target financial independence, target wealth, target legacy wealth over a certain period of time, right? So and that is the reason, this difference happened. And I will definitely share the link to this video with the YOSICon team, and they can share it on the group for the larger audience. But what we recommended to Varun, after he came to us, is that, look, if you are saving whatever is your emergency fund plus immediate spends, you should park money in FDs and savings account. If you have recurring requirements or medium term requirements, क्या 2-3 साल में vacation करना है, कार खरीदनी है, something like this, then maybe you need to have a mix of bank savings instruments and low risk mutual funds, which are not linked very highly to the market, and therefore they are not very volatile, but they will grow at a rate which can do slightly better than FDs on a post tax basis, right? But for all your long term goals, which is about retirement corpus, child education, property, business capital, anything else, you must, use growth assets. Now, growth assets could be anything which you think can deliver a return which is higher than at least 7-8%, which is the normal cost of increase in lifestyle. Uh, so this is a very basic approach in terms of how do you really think about savings and investing, and how do you start thinking about leveraging the power of compounding for your wealth creation journey. And the reason we chose this topic for this audience is particularly because most of you here today would be in your early 30s, late 20s, and you still have a very long period of time ahead of you to start piling up your corpus, think about savings and investing. And which is why, it's very important to understand today that what is inflation, what will high returns do, what will a long period of time for investing do, what can compounding do for you, and what is the difference between what is the difference between safety versus long-term wealth creation, and what is the trade-off between the two. So I think that's it from our end, and we would like to open the house for any questions that are there.
So I think that was the wonderful analysis and wonderful teaching presentation for any young doctor. It's not just ophthalmology, because all the young doctors will be at the same situation when it comes to finance. So you rightly said that the compounding effect comes when you are invested for a very long time. As you shown in your that chart, that at the 5 year it was not a very big significant difference, but at the 15 years it was quite significant, more than double, and maybe over even more further longer period. Most important challenge what I feel for anybody, including any person, is to stay invested for that long time, to make that consistent investment. So, what are the advices you give to your clients to how do they be motivated and keep investing consistently? That is what I want you to share your views, and Dr. Mr. Vikas also.
Yeah, so actually, see, what happens is that we have been doing this since last 10 years. Personally, what I believe first is that as investors, we have to first ingrain in our thought process the belief and conviction about some asset class. It can come by investing yourself, or it can flow in by speaking to someone whom you trust. Because until unless you believe in the asset class, you cannot navigate different times. So, like if you see a lot of Indian households, women have been holding gold since last 10 years, 20 years, and they have never sold it. The idea of not selling gold is because of an inherent belief in the asset class that this is something which should do well in the like next 10, 15 years. Similarly, when it comes to equity or any other asset class, you have to continuously understand the asset class, that what are the characteristics, that when it can be volatile, when it will do well. And if you start understanding the asset class well, it helps you to go to the long term. Also, like you have to see how the asset classes behaved across last 10, 20, 30, 40, 50 years. So if you see like we were seeing one presentation which was again presented by Warren Buffett only. He was showing that just investing in S&P from 1940 till 2005 has gone like 1000x. So those kind of thought process, that how like equity is linked to the Indian economy, how Sensex has behaved, like the first 50 companies they have, like if you see Sensex today is 83,000 and it started at 100. So from 100 it has moved to 80,000. So that has happened over the last 40 years. So India also has a trajectory where we can see how things have moved. And to understand these numbers, you have to actually give some time, and then only you can understand. Maybe Shruti can add.
Yeah, I would want to add to that. So, also one perspective that I would really want to bring here is, and we do financial planning for a lot of our clients. See, the reason I see that a lot of people are not able to actually implement long-term investing is because they don't know what are they investing for. What will they get out of it? So if you know that, so in financial planning, what we do is, like I was just talking to somebody today and he said that, yeah, my son is 1 year old and I would want to send him abroad. So when we extrapolate that number, and aapko pata hai ki you have to accumulate a 3 crore, 4 crore corpus for that in 10, 15 years, then you don't worry about first 2, 3 years of investing. You think about how will I reach that 5 crores number, right? And that 5 crore numbers can be reached through various asset classes. But आप ये सोचोगे कि what is going to, over a 15-year period, what is going to give me a growth rate which will which will ensure that I reach that number. So sometimes when you have a target in front of you and you have a goal post in front of you, you are able to achieve that. And I mean, like, who better than doctors can understand? I mean, doctors study for the longest of time. I mean, like the most number of years, right? And why they're able to do that is because they kind of understand that we have to do these multiple legs of education for us to reach a certain level in the industry, right? Why would you otherwise do MBBS and then you would have multiple levels of expertise that you bring into your field? Similarly, in the world of investing, you need to understand why are you investing for 15 years? Why not for 1 year? Right? And I think understanding the asset class, like Vikas mentioned, and understanding your goal post together helps you bring that discipline to stay invested consistently and ensure that you are continuously maintaining your investing rate.
Fantastic. So we have a question in the chat box from Dr. Sahil Agarwal, I guess. So has there been a static CAGR of about only 4 to 5% for last 1 year or so because of high market. I think I'm not able to understand the question. What he's
Yeah, I
trying to
think it's
ask is,
because of high mark. Because you want to
yeah,
answer this?
Yeah, so see
yeah.
what happens. I think this is a very good question, and I think everyone can benefit out of it. So if you see last 1 year, markets would have given like Nifty. If you see, it should be flattish. So even the returns are not even 1%. But this is one of the biggest understanding all of us as investors we have to understand that markets will not give returns every year, and this is not a bug, but this is a feature. And if this does not happen, actually the returns will further go down, because if there is no volatility in the market, then what happens is that people will bring all kind of money to the market, which is for the short term needs. But market is a place like at least equity markets is a place where it is attracting investors capital for like say 3 5 7 years. And if these kind of phases are not coming, then it brings out a wrong perspective about equity markets. So if you now if you you are thinking about 1 year, if you go to 2 years, the CAGR improves to 10 12%. If you go to 3 years, then it is again like smoothening out. So when you see any kind of return in equity market, like so there was an analysis done by one of the mutual funds. So what they say is that if you are investing for 1 year, you making a positive return is 60%. If you are investing for 2 years, this probability goes to 70%. If you're investing for 5 years, this goes above 90%. And if you're doing it for more than 7 years, most of the time, like over a 10-year period, there are very very few instances where you have not generated less than 8 9%. So it is like close to 98%. So the idea about equity markets that in last 1 year this has given negative return. Also, I would like to add, so when I invest and say I am 36 right now, and if I am investing, if I see these kind of phases in the market where I am getting negative returns, actually that makes me happy, because one has to understand this thing that I am not a like I am not somebody who is looking for income generation from equity market right now, and I am in my accumulation phase. So this is again an understanding which we as investors have to understand, that if we are buying when our returns are showing very very positive, we are actually buying higher. And if we are buying when markets are flattish, we are actually buying when it is cheap. So it is actually in our advantage, but it is very difficult psychologically to accept this fact. So this is how you have to understand the asset class, and you have to see that what is actually beneficial for someone who is accumulating. So I like these kind of markets where my like regular investments are going at a level which is consolidation in the market. So this is what I think about the last 1 year return, and how this can be perceived or how you can interpret it for your own benefit. Want to add something?
Dr. Sahil, basically, I don't think I have much to add after what Vikas has said, but I think it's about understanding that whenever you are analyzing equity markets, it's best to analyze it on 5 year time frames and not on 1 year time frames. So 1 year time frames give you, I mean, if the returns are low over the last 1 year, it just shows that markets have not done well in the last 1 year, and therefore they have become cheaper. The prices have become cheaper because they haven't gone up. So if you, let's say somebody is doing an SIP, right? An SIP is basically money that is getting invested every month from your bank. If the markets don't go down, you are essentially buying the same thing more expensive every month. So it is not going to give you a higher return till the time that trajectory goes down and you end up buying cheaper, and then again it goes up. So if you look at and over a period of time, we'll also share one more link which shows a very good trajectory of the Indian markets over a 30-year period. You will see that there have been so many instances of the markets going down, underperforming, not just low return but very heavy negative returns also. But still, over a period of 15 to 20 years, they've been able to generate a very decently high return, which is aided wealth creation for many people. So you always have to think about equity as a long-term asset class. Vikas rightly pointed out that if everything would have been so good about the equity markets, FD में तो पैसे ही नहीं होते. Everyone would have come to the equity market saying that यार यहाँ तो हर साल पैसे बनते. That's not true. But if you're looking for a 5, 6, 7, 10 year time frame of wealth creation, then that's a good and suitable asset class to park your money. So I
And
think
I'd
we have
like to
another
add
question.
just one more thing, that if you see, like we have data for investing in equity mutual funds over last 20-30 years, you will see that only 10 to 15% of the investors actually create the fund return. So if a fund has generated 15-18% return, only 10% or 5% investor get that return. Most of the people are getting suboptimal return than the fund. So there is a behavior gap which we as investors face, because whenever there is a downturn or when the markets get tough, we start over analyzing and we don't link our investments to our goals, and we take short term decision making. So there are a lot of examples where fund has given instrument has given 15-18% return, but the average investor return is 8-9%. So one has to actually when we see the returns from the market, actually 90% is your behavior, how you can manage yourself across time periods, because wealth is created over 15-20 years, and a couple of wrong decision making can actually interrupt the entire compounding. So you have to be disciplined, you have to be rational across the period of 15-20 years, and then you get the desired result, which requires a lot of learning and I would say hand holding about the markets.
That's great. Even I have read that somewhere that most of the people don't stay invested, and because of market ups and downs, if their emotional decisions make them make some mistakes, then the overall return will be affected. So there is a very good, actually, the scenario with the question Dr. Dipanshu has put, that if a young doctor has 5 lakhs to invest, which one is the ideal model to invest? Monthly SIPs, lump sum investment, or to invest in stocks? Can you just share your advice on that?
Yeah. So I think, see, between SIP, so there are two questions inbuilt here. Number one is whether one should do mutual funds or stocks. And the second question is, within mutual funds, should one do an SIP or a lump sum investment? Right? I'll answer the first one first, whether mutual funds or stocks. So again, I would say that both mutual funds and stocks represent equity as an asset category, right? What does equity mean? They are basically companies which are doing business. They are listed on the exchange. They get capital from the public to do more business. And as they do more business and they grow their revenues and profitability, the people in the market are willing to pay a higher price to be a part owner in the company, in a very layman language, right? Now, how is mutual fund different from stocks is that as a stock investor, you will not be able to invest in a set of, let's say, 50 stocks or 100 stocks, right, with limited capital. But mutual funds give you exposure to a very diversified basket of stocks by investing a smaller amount of money, because what mutual fund is doing is they are pooling all the funds and then buying the stocks, right? So you get mutual fund unit, you don't get the stock in your demat account. As somebody who is starting to invest, our recommendation would be that you should always first start with mutual funds. Why? Because mutual funds are relatively more diversified than a stock portfolio. Therefore, they are less riskier. They will be slightly less volatile than stock portfolios. They will be closer to the largest companies. The portfolios of mutual fund companies are very close to the indices representing the largest companies. Therefore, you will not necessarily be exposed to a lot of smaller companies. Once your mutual fund portfolio has gained a certain size and you have at least 3-4 years of experience of witnessing volatility in the equity markets, that's when you can start thinking about stocks. Also, because if you are doing stocks yourself, you need substantial amount of time, energy, and interest to spend on taking decisions around which ones to buy and which ones to sell. So if you are young and you are starting to invest, mutual funds is the uh, most efficient way to start building your capital in the equity market and also start gaining experience of volatility in the equity market. Now, within mutual funds, SIP and lump sum are two ways to invest, right? Now, even if somebody has 5 lakhs and let's say your advisor feels that the markets are very expensive, the lump sum can be converted into a monthly infusion into equity market. It is called STP. So I think SIP has become very popular thanks to the campaign by AMFI. People don't know about STP. But basically in SIP, what happens is the money gets deducted from your bank account every month and gets invested. In an STP, the money gets deducted from a low risk fund every month and gets invested in an equity fund. So basically, whether you should do an SIP or a lump sum is somewhere a function of where the markets are. But if the markets are slightly expensive, STP is what you can do with a lump sum amount of money, which is not very different from SIP. So it really does not make a lot of difference because the modalities can be, the mutual funds are very flexible that way. So it's completely, we can make it modular investments as well.
So I'll just like to add about SIP and lump sum. So what happens is, if you see data, so lump sum is actually more if you beneficial if you have capital today and if you're investing for 10 years. But behaviorally, it can be challenging. So a lot of people try to stagger their investments because sometimes if you've invested 5 lakh and if there's a correction of say like 20% in the next 6 months, but if you take a data of like 10-20 years, you will find that most of the times lump sum is more efficient. So it is also about understanding your risk appetite and your understanding about markets. If you are a beginner and if you want to take it slow, then what happens is SIPs or STPs gives you that time to stagger your investments, and you will see slightly lower volatility. But if you are an expert in the market, so most of the people who understand the market well, they generally don't try to do a lot of STPs. They may be doing lump sum only, because that is actually more efficient, because markets are generally in an upward trending environment, right? Very few, like this year what you're seeing is not something which happens like say every year. So most of the times if you see, market has an upward bias. Because of that, lump sum generally fares well, but yeah, it depends on individual risk appetite and understanding about markets.
So I have a question. Should I ask? Yeah.
Yes,
So,
yes.
for example, at some point of time, a similar thing happened with me as well. If like my financial planner advised me to divide my entire SIP into say 10 SIPs, and every month I'm allotting a particular amount, let's say 100 rupees to all these 10 SIPs. Now, for example, I've been doing the same thing since last 4 to 5 years. At this moment of time, I realize that one particular SIP is not doing well and one particular SIP is doing very well. Something like the top of my list is somewhere around say 25 to 30% returns, and something which is at the bottom is something between 15 to 20% or 10 to 15%, and it keeps changing around. So what, as a financial planner, like last 6 months I've been watching it, but my financial planner has been advising me to not stop the ones that are relatively less performing, saying that at some point of time in future in the market run, this will be compensated. So should I stop the low performing ones and shift my entire to the high performing ones, or should I keep my portfolio pretty much balanced?
So see, Bhavya, what happens is that when you are investing in mutual funds or when you're doing these SIPs, there can be some funds who are not having their good time right now. So by this, what I mean is that when you're investing in 10 funds, all funds have different kind of objective. So now you have to understand that again, this is I think more experienced people in the markets can have this idea. Like there are various factors in the market which run during certain times. Sometimes value performs, sometimes quality performs, sometimes momentum performs. So now when you are investing in that fund, you have to understand what is the primary factor that they're trying to extract. Just to give you an example, like there's a fund called Parag Parikh Flexi Cap Fund. It is trying to
Exactly.
extract value factor. So if say suppose value as a category is not doing well, and at that point of time if it is underperforming, then you should be okay with it, because the factor that they are trying to extract is not doing well. If value is doing well, they are not doing well, then definitely you can think that if there is a fund manager problem, or if suppose there's some other problem, like say suppose momentum is not doing well in the last 8 months. So if a momentum fund is not doing right now, this is actually a good time to top up, rather than thinking and taking a decision making on the basis of return. So return is not the only factor on the basis of which you take decisions. The decision is taken with a lot of consideration about how things are shaping up. Just to give you an example, like when Prashant Jain was managing HDFC Flexi Cap Fund, it had a lot of exposure to PSUs, and he had a strong belief that these PSUs are undervalued, and sometime at some point of time markets will recognize it. And we saw that it underperformed for 3 years, and all the underperformance was taken away in the year 2023 to 24. So it is more about understanding of the market, understanding of the strategy, but there are certain times that you have to take action also. So there was again one fund which was managed by a star fund manager. It became a big fund, and after he going out, there was a consistent underperformance which is not linked to the factor that the fund was trying to extract, but maybe realignment of portfolio was not happening properly because it was a big fund and the main fund manager left. So if suppose that kind of change is happening, then you can look at changing the fund. But if it is just because of returns, I don't think so that is a good choice.
Thank you.
Thank you, Bhavya.
We have another question from Dr. Daivat Shah. He is a relevant question for his investing style. He invests in global equities as well. So, investing in India versus globally, what's your take? And I would add a very basic question here, that how to invest globally. If you can share some light on that.
Shall I take it?
Yeah.
So see, what happens is I personally believe that investing globally is not a bad idea. So you should try and diversify some of your investments to US predominantly. And if you want to do some tactical bets here and there, like China and all, that is also okay. But generally, some portion of your capital should be exposed to US or some of the better performing economies. But right now, what happens is that it is not relevant for everyone. So if you are trying to take a more complicated way, then I think it should be done beyond a certain threshold of net worth. So that again, you have to try and see that whether it makes sense at a smaller net worth at all or not. When you're trying to invest through India, earlier what was happening is that there was FOFs. So mutual funds have fund of funds through which you can very easily do it. In that case, a certain net worth threshold is also not required. But if you are trying to open a foreign brokerage account and then buying those US ETFs, then that is a complicated process, because in your ITR returns also you have to disclose it. You have to properly report it to ITR. So those complicated process should be considered only beyond a certain net worth. So if your net worth crosses say 2 3 4 5 crores, then what happens is that diversifying 10-20% of your net worth becomes a substantial portion, and it moves the needle a lot. Right now, like what you asked, Nikunj, there are some FOFs which are available, but the problem is that RBI has capped this investment in overseas market through Indian mutual funds to $7 billion, which they have not raised since last 10 years. Because of that, time to time the subscription stops. So right now only a couple of funds are taking subscription. Sometimes they stop. The only problem with that is that we like to build at these valuations. It is always more logical to build at least US exposure via SIPs. And it should not happen that when the markets fall, you are not getting opportunity to top up also. So that is the challenge when you are investing in US companies or US ETFs via Indian mutual funds, which was very, very simple. So from your own mutual fund account, you can do it. There is no extra reporting in your ITR, because this is considered under like Indian reporting only. So these are some of the challenges. If the query is answered, then it is okay. If there is any follow up question, I can answer.
Also, I would like to add that, the question is not about India versus globally. The question, the portfolio construct should be such that it's India and global, right? Because there's significant amount of growth that we are seeing in the Indian economy. So the core of the portfolio can still be out of India, and geographical diversification and tactical bets is what can be taken globally. So we don't need to have an either or kind of a decision making here.
Okay, fantastic. And Dr. Sahil has put one thing that trading requires time, a dedicated one. So vis-a-vis SIPs, especially for a class of society to be busy with patients. So yes, doctors are busy. It's not possible for us to do the actual trading with FNO and all. Or can we still manage trading? So it depends on your time, I guess. I
And
think
also, I like to add one statistic over here. So if you see, SEBI releases a report annually on trading.
yeah.
So the report says that 91% of the traders lose money, 8% of the traders make less than FD return. Only 1% of the active traders make more than FD return. So what happens is trading is a very, 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 I would say, skilled job. If you are one of the best in the like industry in your tact, like then only you can make money in trading. So that requires time, effort, energy, and a lot of things. So generally, it is better avoided until and unless you have a knack and you can actually devote time to it, because the odds are not like in favor of you. You can see from the statistic itself. So it is always better you go to a place like what I told you about investing is that anybody who has stayed invested for more than 10 years has made more than like FD return. And there the opposite is that anybody who has traded for more than 3 years, 99% have lost money, and in the other place 99% have made money. So it is generally more better if you are on the side where you have better odds. So that is what
Also,
is
I
my
would just want to highlight here that it's a very common myth that equity or stocks means trading. Within stocks, like trading is very different from investing. So, as if you are looking at investing in stocks, you don't need to sit in front of the system every day and buy and sell every day, right? So, trading is a very price oriented action, but investing is very, very different. Again, in terms of portfolio construction, mutual funds is what should be the starting point, beyond which stocks can be considered. But when you go to the level of investing in stocks, it should be investing and not trading. Now, of course, it is possible that you don't get enough time to do your research, analysis, study, and take decisions around which stocks to buy, when to sell, how long to stay invested, so on and so forth. So there are enough, you would find good advisors within the stock investing industry who would be able to manage those portfolios for you. So you can actually work with some of those advisors for with respect to stock investing. But trading is definitely not recommended. I hope that answers Dr. Sayan.
Absolutely. So, in a way, and all of us are having a busy work lifestyle. So, I don't think trading is anyways an option for most of us. But yeah, if anybody can manage that, that is the answer, that we should not, rely on trading always and be a long-term investor. So,
We are full
we have
time in markets, and yet trading is not an answer to what we do.
yeah, absolutely. So, Dr. Niranjan, do you have any question? Thank you for joining.
Yes, sir. Good evening. Thank you, ma'am, for the wonderful talk. And thank you, Professor, again. A few take-home points as young ophthalmologists that I took was we have time on our side. So staying invested, starting early was definitely highlighted in your talks today and wonderfully given with the example of the person's example. So my doubt here was that, is it really important for us to choose the different caps within the equity, or is it better? Because considering that in our early stages, we've talked about returns not depending on the returns which you should choose the funds, but within the equity itself, leave alone the debt funds and the whole ETFs and things. So is there a rule that you would suggest for young doctors to diversify within the equity, that is between the flexi, mid, large, and so on? Because that is one area where we want to invest in equity considering the good returns, but at the same time, we are very unsure whether you choose we want to play safe with a hybrid, or do we stick to just equity, or the 50-30 rule exists overall, but your take on that, ma'am.
So see, I think everything needs to have a context. I am not a big fan of thumb rules, right? So there are no thumb rules for anybody. Everybody's context is different, right? So if you are an investor who is just starting to invest, I mean, this audience, of course, the kind of questions we are getting, the people are relatively a lot informed over here. But if you're an investor who is, investing in, let's say, mutual funds for the first time, you have not experienced volatility, you need money in 5-6 years, then probably index and hybrid would be the best category. But again, if you are somebody who understands the fact that there can be periods of volatility, but the long term corpus creation is the goal, you are okay to. So it's about allocation as well. What percentage of your investment do you put in those small mid cap kind of a category? It is not mandatory for everybody to have them. It is a function. So when we create portfolios for our clients, we look at what level of risk are they comfortable with, what level of volatility are they comfortable with, how long can they stay invested, when will they pull the money out, right? And therefore, what percentage of this investment can sit out of these smaller categories? Because see, most of the mutual funds will always have large caps. So if you only invest in large caps, your returns will be very close to what the largest companies can offer, which would be around 10-11% kind of an annualized return. If you want to pull your portfolio towards 12, 13, 13.5, 14% kind of annualized returns, you will need to go to smaller segments and see growth over there. But to go to smaller segments, you also need to have the ability to see volatility, because they will have a lot more, ups and downs in their journey. So it is always a matter of the profile of the investor, after which we recommend what category is suitable to you. If you are thinking that yeah, small cap has given the best return, therefore let me invest in small cap, that's not the right way to make decisions. Returns is just one of the variables. It should not be the way to select your mutual funds. Your mutual fund portfolio should be a function of your profile, and that could be slightly different for everybody. Because if he has anything to add.
Yeah, so I think Shruti has covered it properly, and also see what happens is that as you invest and as you see cycles, you will have more understanding about these things. So it's more about your investing is like like swimming, that you once you start doing it, you start experiencing it. It's just that there are certain times when your conviction would be tested, and those are the times when you have to keep your calm and you have to navigate it well. So it's not that every time your conviction will be tested. It is those times, if you can navigate it well. Because see what happens is that, just for all of us, we have seen a very very big bull market in the last 3 4 5 years. So there can be some periods where our conviction will be tested. It cannot always be rosy. So when your conviction is tested, if you understand yourself well, you can definitely expose. Because if you are generally in these some of these segments, if you stay very long, the returns are better than obviously these large caps. But it also comes with some kind of cost attached to it. It's not that you get the same volatility, same return. It's higher volatility, slightly higher return, and that higher volatility, you have to understand yourself better to see that how much of your net worth you can expose it over there.
I'll just give you a very small example before we end. So I had a friend from MBA. She came from a family which was very risk averse, never invested in mutual funds. She started investing in an SIP with 1,000 rupees, only because I was sitting on her head and telling her nahi karna hai, karna hai, karna hai, and she said कि यार ठीक है कर लेते हैं. And you won't believe. So when she started investing, of course, it was the most risk averse fund, all blue chip. Over a period of time, she saw कि ठीक है थोड़ा return आता है, FD से better आता है. She started increasing her SIPs. Today, she would be doing an SIP of, I think, 2.5, 3 lakhs per month. And a lot of her portfolio is now towards the smaller companies, because what happens is your ability to take risk and your comfort with risk also evolves as you become a more matured investor. And I think, if you are somebody who is not very comfortable at doing all of this yourself, then working with an advisor is very helpful, because all of these discussions can happen with that second person jiski competency ye hai, right? So all of your questions can be addressed by them, and a lot of behavioral change, upgradation, knowledge, the right kind of knowledge fitment for you is done by advisors, by good advisors over a period of time. And that makes you a very different investor in a couple of years. And when you look back, you feel that, yeah, this is a conversation I was having 5 years back, and this is the conversation I'm having now. And you can see that difference in yourself.
Thank you, ma'am. Thank you so much for elaborating on that. Nikun sir, over to you. closing
So, in the interest of time, we'll close up now. But it is an amazing session we have had, and I'm looking forward to meeting both of you in person at YOSICon, and we are going to have a very good discussion over the financial planning and the topic also which we have for the YOSICon is that how a 30-year-old doctor can target a 10 CR portfolio through asset allocation and discipline investing. And I think everybody should attend that and at least learn how to approach your goal. Your goal can be even more than that or less than that, but the approach would be the same. So I would like to thank Mrs. Shruti Agarwal and Mr. Vikas Agarwal for their time and their insights about investing and compounding for all the young doctors. And we'll be connecting again before we meet at the OCCon. The probable date is 19th of August, and that we'll be discussing about asset class introductions like equity, debt, real estate, gold, etc., and different product landscape in the each asset class. So with that, I'll be thanking all of you and have a good night, and we'll see you again. We'll connect soon. Thank you.
Thank you, Dr. Nikunj, and thank you for the lovely audience.
Yeah, so we'll take a screenshot if we have a few
Yeah,
minutes.
no problem.
If you can stay back. Let me just yes. 1 second. Sorry, my screen. Yeah.
Is it done, sir?
Yeah. Wait.
Yes. So
That's your sign.
Okay.
You can help us with that. Yeah. Thank you.
Thank you
Thank you so much.
Thank you so much.
Thank you.
Good night. Good night,
Bye-bye.
everyone.
Good night. Bye bye.